For most of my career, the smartest thing a community institution could do with new technology was let the big banks go first, pay for the mistakes, and prove it out, then buy the mature version 3 years later for less. For many kinds of technology, that is absolutely still the right call. I don't think it's the right call for what's happening in core banking right now. Plenty of systems have always sat on top of your core. Digital banking, origination, fraud. But what's different is that the intelligence layer that's arriving now doesn't just run the process, it learns from it. And the learning only happens to the institution actually doing it. Hi, everyone. Welcome back to Next Move Banking. I'm Virginia Heyburn, Principal Strategist with Engage FI. Over the last 6 episodes of this core banking series, I've argued that the economics of this market are changing in ways that we haven't seen in decades, and that the advantage is moving above the core itself. Which brings me to the objection I always get when I'm having this conversation with a financial institution CEO. That all sounds great, Virginia, but we just don't have the talent. Talent matters. It always will. But the talent required now is less about who can build the technology and more about who can choose it well and govern it. That shift is what my 5th and final prediction rests on, that the safest strategy has become the riskiest. What do I mean? The institutions that lose ground will lose by carefully applying a strategy that used to be right. They'll hold off on building the intelligence layer above their core until it feels proven. For decades, waiting was not hesitation. It was prudent capital allocation. Let the large banks spend the money, absorb the risk, and 3 years later, you bought the better, cheaper version with far less uncertainty. Web services were going to transform banking. Service-oriented architecture was going to redefine the platforms. I remember 25 years ago, a wave of new providers was going to remake the core banking market with modular core replacement. API banking was supposed to change everything. Very little change, particularly for the community banking space. And very little of it was priced for an institution of your size. So waiting was not only disciplined, a lot of times it was the only option on the table. But notice what every one of those waves had in common. They improved how systems connect. Not one of them changed how institutions learn. That distinction is the entire game now. Those technologies were products. They didn't get more valuable because you owned them longer. And whether you bought in year 1 or year 4, you were buying essentially the same capability. A learning system doesn't work that way. It improves with use, which means that waiting no longer delays the value. It basically gives it up. Software can still be purchased later, but learning can't be. So let's come back to talent, because I want to be very precise about what exactly has changed. Community banks did not suddenly gain access to unlimited technical expertise. What changed is how much expertise it takes to begin and what kind of expertise it takes to begin. The flex now means choosing the right technology, integrating it, governing what it costs, and importantly, pointing it at the problems your institution understands better than anyone. Community banking has been running this exact playbook for decades. Your core came from one provider. Your digital platform maybe came from another. Treasury, fraud, lending, CRM, all of it assembled rather than built. Community institutions have always been integrators of other people's technology. Nobody ever called that a talent gap. And AI is now becoming one more capability inside that ecosystem. The scarce resource isn't writing models anymore. It's judgment about which capabilities matter first, which vendors fit your strategy, and which contract terms preserve your flexibility. Being able to pivot on a dime is really important in today's market. Those are strategic questions. They're not staffing questions. And banks that answer them well with a small group of people who understand the business will outperform the ones chasing technology without a strategy. So headcount isn't the constraint anymore, decision-making is, which is why timing matters so much. The capability you'd be building compounds. Imagine 2 institutions in similar markets, comparable balance sheets, equally capable people. One starts building today, and the other waits 3 years until the technology feels safer. 3 years later, they can buy many of the same tools. What they can't buy is 3 years of those tools learning their business. At the institution that started, the fraud models have seen 3 years of its own losses and corrected against them. The pricing has watched 3 years of its own customers respond. Every decision the system made, good or bad, came back as a result it learned from. And because those decisions were your people's decisions, the system has been absorbing something else along the way. It's the judgment that used to live only in conversations, handwritten notes, and in the heads of individual people, lenders, for example. That judgment, now captured, may be the one advantage a community institution holds that the largest banks can simply forget about acquiring. They can't do it. No national institution understands your customers, your market, or your lending culture the way you do. The only question is whether that knowledge stays locked inside individual employees or it becomes something the institution owns and improves every year. So waiting doesn't just postpone implementation, it postpones accumulation, and accumulation is where the advantage is going. When this series began, I made the case that the economics of the core banking market were starting to change, and it was a really pivotal time in our industry. When economics change, markets change, and they become more accessible to smaller banks. And that's why I'm so optimistic. Community institutions have always held extraordinary strengths. Deep relationships, local knowledge, very experienced lenders, and judgment built over decades. For most of banking's history, those strengths stayed trapped inside individual people and individual conversations. But for the first time, you have a way to capture that judgment, keep it, and improve it. This market is starting to reward the very things community banks were already best at. The institutions that move first won't win because they bought more technology. They'll win because they learned faster and because they turned decades of judgment into an advantage that compounds. Next week, an intelligence layer readiness scorecard to work through with your board. 5 questions I ask when an institution brings us in, including one number I think most banks are getting wrong by about 30 points. This series was really built to start conversations. And if you're working through any of this, core banking strategy, intelligence layer strategy, overall technology visioning, the vision, the contract, the plan that connects them, these are all conversations that we have every day at Engage FI, and we'd be really happy to help you think it through. I'm Virginia Heyburn, and that's your next move.